Good morning, everyone. My name is James McQueen. I'm a partner in BDO Auckland, and I've led our construction specialisation for about the last 6 years. Today, we're exploring a number of key macroeconomic challenges impacting New Zealand's mid-market businesses and diving specifically into the construction industry. We find it's a great economic indicator of what's more broadly being experienced by the different industries and regions throughout New Zealand, and it's historically been a very good indicator of future trends in the economy. I'm joined with Jared Kerr, Chief Economist of Kiwibank, a renowned New Zealand economic expert we regard as a good friend of BDO. So in that sense, he needs no further introduction. And Nick Innes-Jones, a fellow BDO partner and also a leader in our construction team. Jared will first take us through his view of the economy, both internationally and nationally, for 20 to 25 minutes before Nick shares his key insights on the construction sector for about 10 minutes. Our intention is to leave time for your questions, so feel free to post using the chat box and we'll endeavour to get to as many of these as we can. Currently, the construction sector is operating at levels not seen previously. This is despite the considerable headwinds being faced through lack of sufficient staff, major material shortages, severe inflation, and also significant disruption on building sites caused by COVID and the previous close contact rules that meant that a lot of sites were running with very few people on them. Jared, I'm really looking forward to this session. Thanks for being with us once again, and I'll hand over to you.
Right, thank you. Thank you very much for inviting me back today. I always find these sessions incredibly insightful. As economists, we like to think we know what's going on and what's happening in the world, but it's not until we do sessions like this and we hear in the Q&A what is actually faced by businesses like yourselves, what are the stresses, what is front of mind, and we always find these sessions to be incredibly insightful. So thank you for inviting me back, and thank you for joining us this morning. There are a number of things I want to go through today, but there are three broad themes. The first is the fact that we are very much focused on the Omicron outbreak and the war in Ukraine and what that's doing to commodity prices and global supply chains. Global supply chains remain seized in parts, and commodity prices have lifted quite substantially. We've all seen that at the petrol pump, and what that means for our economy in the near term. And it's obviously putting a dampener on growth and business confidence. But there is light at the end of the tunnel. The good news is that our borders are reopening, so that'll be a nice shot the year, and we are expecting migration to pick up into next year and help alleviate some of the supply shortages we've got in the labour market. The second point that I'd like to make is New Zealand's terms of trade is at a record level. It's something I raised over the last year or so, something I continue to point to. Our export prices are very high relative to our import prices, and that is a huge income boost for rural New Zealand. So the New Zealand economy is slowing, it's cooling, but it's got good momentum behind it, and we've got some good income coming through the rural sector of New Zealand. The last point that I'd like to make is that we've got a very tight labour market, we've got very high inflation, wages are rising, and we have a central bank that's trying to get on top of inflation. So what they're doing is lifting interest rates. Interest rates have lifted a lot over the last year, but have got much further to go. So one of the key takeaways from today is that interest rates have risen and they will continue to rise into next year. And that's all interest rates, whether it's a savings rate, a mortgage rate, or a business lending rate. All mortgage rates, all lending rates are rising from here. Now, if I just go to my first slide, back to my original point around the focus on Omicron and the war in Ukraine, global inflation has picked up. So inflation around the world has lifted, and that's the green line there, you can see global inflation really has spiked over the last year, and that's been driven by two major forces. It's been driven by the disruption to global supply chains, which look like they're going to remain disrupted for quite some time. We've seen a 5-fold increase in the Shanghai Shipping Containerized Freight Index, which is the one that we use here in New Zealand. That is being passed on to consumers. It is causing all sorts of problems, in the construction industry as well, inability to get materials. But that cost, that looks like it's going to hold for quite a while yet. And of course, oil price. The oil price, the chart on the right there, has also screamed higher with the war in Ukraine. That is being felt globally. Petrol, oil goes into just about everything. So when you see an oil price shock like that, you see global inflation picking up. And these factors are causing havoc in financial markets. We've seen some very high volatility in financial markets. We've seen equity markets hit quite hard at the beginning of the year. They've made a romping comeback in the last couple of weeks, but they have been hit pretty hard since the start of the year. The chart on the right there shows you global growth or global industrial production against equity market returns. And since the Omicron outbreak, we saw global growth expectations come back down, and we saw equities come back down. It looks like that's bottomed, and looks like global growth is about to pick up over the second half of the year. So that should be supportive for equity markets in the second half of the year. But for now, we're in a very volatile time. The chart on the right there is probably the most interesting. You can see equity markets have done what they've done, but underneath equity markets, we've got interest rates. We've got the global benchmark bond, which is the US 10-year government bond. And you can see that the interest rate on the 10-year government bond really has spiked in the last couple of weeks, or the last month or so. What that means is central banks globally are facing into inflation, and we've got central banks globally lifting interest rates to try and calm inflation down, trying to cool inflation down. And the US Fed has started lifting interest rates, and looks like it's going to start lifting interest rates quite aggressively. So one of the key messages today is that interest rates have risen a lot, but we expect interest rates to rise quite a bit further over the year ahead. And global interest rates do tend to move together to varying degrees. And you can see that since the lows of 2020, we've seen interest rates globally pick up quite a lot in the last year. And I expect that to continue. So New Zealand interest rates are really just a spread to US and Australian and other interest rates around the world. We're seeing all interest rates lift higher. That's putting upward pressure on New Zealand interest rates across the curve. So it doesn't matter whether it's a 1-year rate or a 10-year or a 20-year rate, all interest rates are rising. And that's being translated into higher mortgage and higher lending rates. I don't expect that to change. I do expect interest rates to continue to lift as central banks face into inflation and actually start lifting interest rates over the year ahead. Now, looking at the remarkable New Zealand economy, we really have performed quite well given the pandemic, given the disruptions. We've had two very much V-shaped recoveries around our big lockdowns. So the first lockdown in 2020 caused a decline of around 11%, which is massive, but we bounced right back. And the Delta disruption of last year, the lockdown, particularly in Auckland, caused another decline of around 3.6%, but again, we bounced right back. What you'll notice on that chart, though, is that we've got growth expectations going out the next few years, and we've got a trend line running above it. So we're going to be running below trend for a while, and that is because of higher interest rates, and that is because of business confidence having been hit. One of the big concerns for us has been the drop in business confidence. Business confidence more of a concern. Investment intentions really has declined into this year, and businesses are wary and very much battening down the hatches around the Omicron outbreak, war in Ukraine, the supply disruptions, high inflation, pressures on margins and profits. It's a difficult time for businesses at the moment. We do expect business confidence to bounce back in the second half of the year as the borders are reopened. Hopefully we get some sort of end to the war in Ukraine, and hopefully we see global supply chains starting to free up a little bit by the end of the year. But for now, business intentions are very much in the decline, and businesses are worried. That is not good for growth. We want businesses to be confident to invest, and that fuels growth, whereas businesses that are battening down the hatches and not willing to invest, obviously that kills growth. The one thing that hasn't changed is hiring intentions on the left. So you can see that hiring intentions very much remain the same, regardless of what's going on. It just proves that we've got a very tight labour market. It's very hard finding workers, and businesses are struggling to fill the positions that they have. And that will take quite a bit of time to play out. But as I said, the borders are opening, and we are expecting migration to return into next year. One of the other pillars of growth has been the government. The government does have a lot of spending that it wants to get done. And you can see in that fiscal impulse for 2022, there is a decent impulse. There is a decent amount of government stimulus still coming through that will be supportive for growth. And we're doing it with very, very low debt. We will end up with more debt than when we started. We'll end up with around 35% of GDP, which is actually very low compared to our peers. Now, the point I raised before around the terms of trade, if you look at our terms of trade going back to 1861, we've never had a terms of trade this high before. Now, what that terms of trade measures is our export prices relative to our import prices, and our export prices are at record highs. So we're getting record high dairy payouts. There's very strong demand for meat, forestry, and other primary products, and we're reaping the rewards of that. Now, it's been an awkward season in terms of weather, but the prices that our farmers are receiving is more than enough to offset the increase in costs that they have, and it is a decent income windfall for the country. Now, with that in the background, as I said before, we've got a very tight labour market, and our unemployment rate's at 3.2%. Now, with such a low unemployment rate, naturally you would expect wages to lift, and wages are starting to rise. And we do expect wages to continue to rise over the year ahead. With such a tight labour market, with such high inflation, wages can only really go higher from here. So that's another headache. That's another cost for businesses, on top of all the other costs that are rising within our economy. Anything to do with the housing market, anything to do with construction, we're seeing massive increases in costs. How long that persists for, I don't know. We'll hear more later from Nick, but there is quite a meaningful increase in construction costs in New Zealand, and those global supply chain disruptions are certainly not helping. With all that inflation brewing, wages, construction costs, all the inflation that we're seeing across the economy, we've seen inflation expectations lift. So when the Reserve Bank does surveys of businesses like yourselves and asks them, you know, where do you see inflation in 1 year, 2 year, 10 years time, the responses that have come back have actually started to concern the Reserve Bank. It looks like inflation not only is spiking near term, but it looks like it's going to persist over the next 10 years. So the expectations of where inflation is going to average over the next 10 years has lifted above 2%. Over the next 5 years is lifted, you know, towards 2.3, 2.4%. That worries the central bank because their mandate is to keep inflation between 1 and 3, and they target 2%. So the fact that inflation's rising, or expectations of inflation are rising above 2%, is a threat to their credibility, is a threat to their mandate. And this is why the central bank has come out guns blazing and said, we're going to raise rates. We're going to raise rates quite aggressively, and we're going to do it in a short period of time. So what we've seen from the central bank in the last couple of meetings is a pulling forward and a lifting of their OCR track. Now, what their OCR track is basically a forecast as to where they expect the cash rate to be over the next few years. Now, the cash rate's at 1% today. They're telling us that they expect the cash rate to be at 3.25% in 2023, 2024. So quite a seismic shift in interest rates. To put that in perspective, a neutral cash rate would be around 2%. That's neither too tight nor too easy. That's about right. So not only are we going from an easy situation through neutral, we're going into a tight policy stance. So the central bank is telling us that not only do they need to normalise policy, but they actually need to tighten policy to rein in the economy and rein in those inflation expectations that I mentioned before. Now that is going to put more upward pressure on mortgage rates. So you would have all seen the announcements of the last week or so. Banks have been increasing their mortgage rates. They're back to levels that we haven't seen in a few years. Well, there's more coming. There's more interest rate hikes coming. As the central bank lifts the cash rate, we will see more and more hikes to mortgage rates and business lending rates over the year ahead. So we're going back to levels we haven't really seen since 2013, 2014, and that will concern some. Most of us who have been in the market for a while will have experienced mortgage rates with a 5 handle or with a 6 handle, but there are a number of new buyers who have only been in the market a short period of time who would never have seen mortgage rates increasing, let alone going back to these levels, which I'd consider to be more normal. So there are going to be households that come under stress, and there are going to be households that will have to tighten up the purse strings. But the key message today, I know interest rates have lifted. I know they've lifted a lot, but there's more to go. Now, with that in the background, the housing market is in retreat. You can see that house prices have already started to come off. We've gone from very unsustainable gains of around 33% in the year to August last year. Now house prices are running at about 10% on an annual basis, but we expect house prices to fall and fall by around 5% by the end of the year. We are not as pessimistic as some of the other economists out there calling for 10% plus declines. And the main reason we're not as pessimistic is simply because we've got such a strong labour market with an unemployment rate of 3.2%. We don't think we enter a period of forced selling and very large declines in house prices. What we are seeing is interest rates biting, the regulation that's come through, particularly the CCC, FA, LVR restrictions, and removing the interest deductibility for investors, all having an impact on housing, and all putting downward pressure on house prices. So house prices to fall by around 5%. That's not a big decline. That's what we'd consider to be a mild correction or consolidation in prices after such a unsustainable gains that we saw in the prior year. One of the main reasons why we don't expect house prices to fall in a material way is also the fact that the market remains undersupplied. So if we measure a housing market and we think about population growth, so demand and number of houses being built, we simply haven't kept up with demand over the last decade. So we've built up a shortage of around 80,000 dwellings. The good news is that with the borders being closed, our population growth has been constrained, and we're seeing quite a healthy lift in supply locally, and we're starting to see housing supply outstrip demand, and we expect that to continue over the next few years. That's important because we'll end up with a housing market which is in much more balance come 2023, 2024. But for now, the housing market remains undersupplied. There still is a chronic shortage of dwellings around the country, but we are slowly eating into it. So in summary, I think our economy is doing particularly well. There's good momentum. There's good income coming through from the rural sector. There are some concerns around business confidence, the Omicron and whatever other variants may come, the war in Ukraine, all of these things are weighing on confidence. But I do think we've got good momentum, and I do think things start to pick up over the second half of the year. And I'm really looking forward to your questions. I'm going to hand over to Nick now.
So thanks, Jared, for that very useful insight into the economy. It's really good to know that my mortgage rate's going to increase over the next few months and upcoming years. So good morning, everyone. My name is Nicholas Jones. I'm a partner at BDO Construction Sector Specialist, specialised in construction for the medium to larger end of the market in Auckland. So for the next 10 minutes, I'll discuss my perception of what's happening in the market, how the market is changing, and changes construction companies can make to their business. So firstly, a quick overview of the current state of the construction sector. And note, this is based on my observations in the Auckland market. And generally, it is very positive. The construction sector has been a standout post-pandemic performer. And currently, there are some really positive signs. So residential consents are up 22% annually, and this current level is an all-time record. Non-residential building work consented is up 16% annually, and there are a record number of tower cranes standing tall across New Zealand. Whenever I meet clients or talk to them on the phone, the standard line I get is, "Nick, I have too much work on." They have more work on than they can handle. 2021 for the residential market saw a surge in demand fueled by record low interest rates and increased disposable income. Larger head contractors in the commercial sector regularly comment to me they have 2 to 3 years forward work. They're turning down jobs they never would have turned down in the past. They simply cannot take on more work. Our BDO construction benchmarking also shows FY21 was a good year for most construction companies in general. So a few other insights into the market. Architects have commented to me that they've been through a boom period. However, they see uncertainty ahead in the market. With regards to materials, clients often talk to me about chipboard and the lack of supply. This is all over the media. And there are a number of other materials in short supply. EBOS's latest survey of suppliers shows building materials are set to rise another 11% in the coming 6 months. This is on top of a 34% price increase or price hike in the last year. Small to medium businesses in particular are struggling with extending waiting periods for materials impacting jobs. And there are supply chain woes. Freight costs have skyrocketed, where a 40-foot container costs US $1,000 in 2019 and now costs between $6,000 to $12,000 US. And there are a short of trade specialists. For example, a client recently told me they found it difficult to find brick and block layers. And there is some desperation out there. We've heard of money being offered to subbies to walk off current jobs and to start a new one. And finally, with regards to staffing, employees are jumping around for higher salaries, leading to cost blowouts and further delays. So the construction market is booming, however, there's some storm clouds coming in. So the construction market in some areas is starting to change. Tighter credit conditions, rising material and labour costs, and lengthy supply chains delays have dampened demand amongst developers. The residential market is changing. There's a perception of softening of the residential market in the medium term from a construction perspective. The key question is what will happen to residential once existing contracts are complete. The residential construction market is busy, but there will be a lag. Residential, may become softer in the next, let's say, 6 to 12 months, most parts of New Zealand. I guess that's quite difficult, difficult to predict when exactly will happen. Cash flow pressure is also increasing. The industry was forced to hold more stock and place larger orders because of longer lead times. This creates cash flow challenges. Also, as building becomes more expensive, the amount required for bonding is increasing. With regards to fixed price contracts, builders cannot forecast price rises, and fixed price contracts are becoming less and less common and strongly discouraged by professional bodies. Bank lending is also changing. Lending is a major issue. Bank appetite for developers and people buying homes is falling. There is a significant amount of conservatism around the construction industry, concern that head contractors and subcontractors do not have buying power. Cost escalation has been passed to them and they're struggling to secure supply. Project delays are hurting cash flow, especially around staffing and holding the cost of materials. COVID support and delays has also impacted the industry. COVID disruption has hit cash flow and profitability more than people appreciate. There is not the same amount of COVID support now as there was in 2020 and 2021 from a cash flow perspective. Delays are costing money. COVID has not helped the market. Large employee absences have slowed down jobs, and project durations have been blown out in too many jobs, which has eroded margins. Reopening the border is a serious concern for the construction industry, being the potential loss of people to Australia and beyond. Staff have also been delaying their OE. Let's hope people can come back from overseas and we'll get skilled immigration. Materials, as we know, is a major issue. There's a lack of supply of materials, jib being the biggest issue. It's hard to substitute, so it's creating delays. With residential softening, it may eventually resolve some material issues in the commercial sector, but not immediately. And there's a shift of labour's potential, with labour potentially being shifted from the residential to the commercial sector. So looking into a crystal ball, projects may be cancelled as they're no longer viable to commence. The key question is how can the sector deliver reliably on the significant building and infrastructure projects in the current pipeline? There will be some financial stresses, especially in residential as the market cools. So there's been a few recent high-profile collapses in Australia in the past few weeks, and these are a warning sign for New Zealand. The first one being ProBuild Construction, and this was put into voluntary administration. This was Australia's 5th largest construction company. It was placed into administration citing issues with rising costs. ProBuild had annual revenues in excess of $1.4 billion. It blamed the collapse on factors such as including COVID-19 restrictions, saying the business had not been able to complete projects on time, and been able to deliver with variation to delay claims. The collapse left 2,300 creditors on the hook, with employees owed about 14 million. Another high-profile one recently was Condev Construction, and that's gone into liquidation, and that's based on the Gold Coast, and that was contracted to build 18 new projects, but valued at $1 billion. And they cited increasingly challenging market conditions, including the exponential rise in material costs, which rose by 25% in 18 months. And this required Condev to source alternative suppliers and subcontractors at an increased cost, which contractually could not be passed on. So why am I raising this? Well, New Zealand companies will face similar issues. Most will manage, but many of these may not. So what are some of the things construction companies can do in the market with regards to the risks I've highlighted? And some of these applies to non-construction companies. So the usual trap with builders, subcontractors and suppliers during this period is not focusing on cash flow, selecting the wrong clients and projects, and trying to retain the peak turnover in workforce. Cash is king, can't stress this one enough. Reduce your overheads, slow down capital expenditure, and reduce the margins you obtain on jobs. Also consider downscaling. The materials are not there, can you continue to pay a full workforce? Have a monthly forecast for the next financial year and stress test your forecast for unforeseen events. Review your monthly accounts. This is an important one. I'm amazed how many construction companies do not review their monthly accounts and understand how their business is performing. Monthly financial reports are meaningless unless the work in progress accounting adjustment has been calculated on a monthly basis and retentions movements posted monthly. Build balance sheet strength. This is especially important for bankers. Tax pooling is sometimes forgotten and is a great tool, especially if you have debt, as it generally at a lower interest rate than the bank. Now, I love benchmarking, so consider benchmarking against your peers, which is something we actively do at BDO for the construction industry. And monitor your gross margin on projects, especially on a monthly basis. With regard to staff and subcontractors, these people are critical to projects, getting projects completed. So for staff, consider golden handcuffs such as shares or bonus schemes to hold employees in the business. If you're well established and looking after staff, generally they will not move. For subcontractors, review and collect your outstanding retentions. And a tip for head contractors, maintain the spread of subbies and review subbies' financials where possible. And if a subcontractor collapses, it can impact the whole project. Contracts are critically important to get right, especially in inflationary times. So homeowners need a contingency now. They cannot be building to their absolute budget. So traditional contingencies of 5 to 15% may be too thin in the face of delivery dates and price increases being seen across the board. Builders should have cost escalation clauses and no fixed price contracts. While rising material costs make the task of accurately estimating projects almost impossible, they can be covered in allowances, in most cases not in cost escalation clauses. And communicate the ongoing situation with your clients and calculate the true cost of delays. Finally, take a helicopter view of your business. Focus on your best quality clients, work, staff, and look for the best medium to long-term strategy. Organisations are likely to be more resilient when they have a leadership and a culture that actively plans and allows for constant change. So resilient companies learn from the past and use those lessons to focus what matters. Experience is critical, so consider an advisory board or a coach or mentor that understands your industry and business. And consider training and career development within your organisations. And succession planning is critical, especially to retain top talent. So this was just a number of examples of things you can do in your business, and not all of them are solely in relation to construction, and what are really challenging times. So back to you, James.
Thanks very much, Nick. That was particularly insightful. Also, thanks, Jared, as well. I'll come back to that. Tell me, Nick, in your capacity as a partner at BDO, what are a few of the issues that you commonly see that are easily fixed that would make a big difference on how people run and manage their business.
Yes, thanks, James. Look, I can't stress probably this one enough, and it's probably quite a simple answer, is that really to review your monthly accounts thoroughly, review your monthly balance sheet, and not just your P&L, and really look at your cash flow levels and your debt levels, and forecast out and to see and stress test them. So if certain events happen, what does happen to your cash flow and your debt levels? And what I often see is people don't accurately post a work in progress journal into their accounts on a monthly basis, or their retentions journal. And this is really it's critical to get your financial records right. So, you know, in these really challenging times, you really need those monthly accounts right and to have a really accurate reflection of where you're at. So don't wait to year end or you know, or to your external accountant done the books. Stay on top of your results on a monthly basis.
Thanks. The next one's for Jared, but I'll just introduce it a little bit more first. Jared's graph showed when we had that first lockdown back in March 2020, we saw in the construction sector just a massive and very rapid loss of confidence. A lot of projects that were ready to go were cancelled and never started. And then we saw construction companies, out there desperately trying to find new work, and as a consequence, lowering their margins, in my view, to unsustainable margins to try and secure work. Now we've got Jared's graph showing that business confidence is declining further. Previously, we had interest rates low. Now we've got interest rates going up, so it's a different situation. And there's sort of two questions here, Jared, that both link. One is, if there's a lack of business confidence, who's going to invest in building houses moving forward? And the other bit of that is, how do we actually get business confidence back up again, so that we don't see some of the silly things that we saw back in April and May in 2020?
Yeah, excellent point. And that's basically the crux of what I was trying to get across, that of all the concerns out there that we have, the biggest is that business confidence has taken a tumble, has been hit quite hard by everything that's going on over the last 5-6 months. I think naturally business confidence will improve over the second half of the year as growth comes back, as our borders reopen, and hopefully as global supply chains and global inflation start to ease a little bit. But you can easily see a situation where business confidence remains in the doldrums for a while, and that really does kill growth, because, as you say, who's going to invest in the houses? Who's going to invest in commercial and other areas of growth for this economy? So yes, it is a major concern for us. We do believe interest rates are playing a part there as well. So I think that it's a bit of a wait and see. Hopefully the war in Ukraine resolves itself somehow. Hopefully, China moves away from its zero COVID policy and frees up some supply chains. Hopefully we're in a better situation in 6 months.
Thanks for that. And I've got another question for you, Jared, from Ben, who says the economy is doing well, but isn't that due to unsustainable government stimulus? We've certainly seen that in the construction sector, with KO out there just engaging lots and lots of construction companies to build as many houses as they can.
Yeah, so government stimulus has been a big part of the growth story. There's no doubt that the wage subsidies and the various things the government has done has helped the economy through what's been a very awkward couple of years. Some of it is unsustainable. Other parts of it, infrastructure spending, I don't think is unsustainable at all. I would argue that New Zealand doesn't have a lot of debt in the Crown balance sheet. We've got a lot of debt in our councils and a lot of debt privately, but we don't have a lot of debt in our central government. So our central government really does need to step up and do more on infrastructure in this country. But yes, the fiscal response has been huge compared to other countries. and it has been a big pillar of support for this economy over the last few years. The government is obviously wanting that support to come off over coming years and start trying to head back towards surpluses, but that'll be a few years away. One thing that we will note going into the May budget is that the government has a lot more revenue than they thought, and fewer costs than they thought as well. So their fiscal situation is actually very good at the moment, and that's just on the back of a very low unemployment rate. So more people paying income tax, fewer people on benefits.
Yeah, that's good. There's always a question on interest rates. I think it's probably the favourite question the economists asked. So this one from Malcolm was, what do you think interest rates will be in mid-23 for retail mortgage lending?
I think you'll see that mortgage rates today are all starting with a 4 and an early 5 sort of handle. That 4 to mid 5% range. It'll be mid 5s to mid 6s, maybe even a 7 on the later, on the sort of the 5-year type rates. So yeah, mortgage rates have got further to go by at least 1%, I think.
Yeah. And then one that sort of crosses over both of you, but it's probably again a Jared question, from borders opening. What are we going to see in terms of wage inflation, particularly around construction? Is it going to stabilise, reduce, go up? It's a bit of a crystal ball for people as to, is it going to be an outflow and inflow, and what's it going to be doing to wage rates?
So we've modelled what we think is going to happen with migration, and because of the staggered entry of migrants from waiver and non-waiver countries, we're expecting an outflow of around 20,000 Kiwis. So Kiwis doing their OE, Kiwis looking for jobs in Australia and other areas. So it'll be a net outflow, which will only tighten the labour market here further, only make things worse, which I think Nick alluded to before. But then by this time next year, we're expecting migration to be plus 30, so a full swing in the other direction, and for migrants to come in. We're really waiting on countries like China, India, and South Africa to be allowed back in October.
Thanks. And that ties through to another question, which was, as the construction sector softens, will prices materially, either labour or materials, stay elevated from where they are now? And I'll try and give my view on that, is that I can't see anything happening in the sector at the moment that's going to be a softening of the prices and costs. They're still going up. There's still a shortage. Those shortages are going to remain for quite some time. Even, it's not till 2020, late 23, I think, that this next jib factory comes on board. So we've got so much jib to make that it's going to be really holding things up. So I can't see a softening there. I imagine, Jared, you probably see a similar view.
Yeah.
Yeah. Another question, other than commodity price increases, do we have prospects for scaling the New Zealand economy beyond sort of the 200 billion GDP levels?
Yeah, I think so. I think the New Zealand economy is reasonably well placed for the next few years. We need to focus more on the tech side of the economy, because I think that's where there's a lot of upside. But we've still got oodles of construction that we need to do in this country, whether it's large infrastructure projects or residential construction, commercial. There's a lot of thoughts on this. I mean, what do you think over the next few years?
Okay, there might have been a little bit of breakdown there, but there'll be a report later on. One of the questions from is what do we expect to develop? Be backed by a funder, it was the bank, when all they want is fixed costs and won't allow, banks won't allow escalation. And what's that going to sort of, how's that going to impact on future projects? I think we're already seeing that, where there's developers that have signed up to buy land and now realise their project is no longer viable and are trying to exit the sale and purchase agreement. In some cases, forfeit their deposits because they know that the project is just no longer viable. And then similarly, we're seeing lots of developers with substantial new build projects go to market for their pre-sales and simply not getting the pre-sales. So it's not going to have an immediate effect on housing because we're still building lots of houses. But Jared, do you see that being a significant change in the housing sector, sort of looking out sort of 12 months?
Sorry, I missed a bit of that. Sorry.
That's right. So what I'm saying is right at the moment, there's a significant lack of confidence from new house buyers, and therefore there's developers that are trying to promote their projects but not getting the level of pre-sales. Is that going to continue, or do you think that will be sort of short-lived, and then because there's an overall shortage of houses, that things will pick up again?
Yeah, I think it's going to be something that'll be quite a dominant force for a while now. We're in a market which is in retreat, and confidence around pricing is going to be dented. But I think because we've got such a shortage of housing, it'll iron itself out, and next year we'll see both prices increasing again, but also a lot of activity returning because there's simply a chronic shortage of housing around the country.
Yep. And poor old Jared's getting all the questions here, I'm sorry. The next question was, what's going to happen to our economy as a result of the transition to net zero?
Well, that's a very good question, and we hope we can transition our way through the move to net zero. As suggested, there's going to be some winners and there's going to be some losers in this, and we hope we can manage the losers through, but there's first mover advantages, I think, in this world, and the companies that move first are the ones that are being rewarded for doing so. So the companies that are becoming B Corps, the companies that are out there doing the best they can already, getting favourable conditions for debt and business. Customers really are demanding that businesses act swiftly. So I think there will be a lot of winners and losers in this, but the ones that react first and go the hardest are the ones that will be rewarded the most.
No, that's good, and that's probably a really good comment in terms of moving to finish up, and for people to sort of think about in terms of how they can be the first movers. So a huge thanks to both Jared and Nick. Really insightful, useful comments. We've got a lot to consider in planning how we plan and operate our business in the year ahead. We will be running our keenly awaited construction survey again this year. We're just finalising the topics at the moment, and questions relevant to the current environment, and questions will be sent out later this month with the intention of issuing our report in late June or July. We will post a recording of the webinar on the website. Unfortunately, Nick's slides weren't showing up, but if you have a watch of the recording, you will see Nick's slides so that you and your team can view it. Our next webinar will be exploring what's happening in the tax world pre-budget. That one is going to be titled Rethink Your Tax, and a pre-budget update. So what we're expecting the budget to have is a focus on government's health reforms, reducing emissions, climate change. And currently the government is saying no big tax changes, but let's wait and see. So the things in that particular webinar, we're going to be looking at the latest developments relating to the personal services income and avoiding the 39% tax rate. There are proposals that going to impact people wanting to sell their businesses. So we're looking at that. Trust compliance. When is a capital gain not a capital gain, particularly with share trading, cryptocurrency, and our budget wish list for what we would like. That's going to be presented by Ian Craig, our Eye on Tax, and Mark Lotter. But thank you again to Nick and Jared, and thank you for everybody participating in this webinar. Please reach out to your local BDO advisor on anything that's been discussed today with any queries, or to help you grow and be successful in 2022. So have a great day.